Trump just picked the next man who controls your money. This decision could affect your savings faster than the 2008 crash. And gold crashed the moment markets heard the name. If you save money, invest money, or earn in dollars, this affects you directly. Kevin Warsh, former Fed governor, Wall Street insider, Stanford economist, and a man who's been publicly calling for what he describes as regime change at the Federal Reserve. Now watch carefully. The dollar surged on the announcement. Gold plunged. Global stocks edged higher. Markets are telling you something. They're saying, this pick signals lower rates, but not chaos. But here's the part most people won't understand until it's too late. This isn't just about one man getting a new job. This is about control. Control over who sets interest rates. Control over how the Fed manages trillions in assets. Control over the institution that backstops the entire global financial system. This is like changing the pilot of a plane mid-flight, while passengers are still debating whether the destination is right. And the fight isn't over. A Republican senator just said he'll block any Fed nominee until the criminal investigation of Jerome Powell is resolved. Powell himself may stay on as a governor, specifically to prevent what he called political capture of the Fed. I've studied Fed cycles longer than most Wall Street analysts. I've seen this pattern more than once in my lifetime. When the people who control money start fighting over who controls the controls, that's not noise. That's a regime change in motion. This affects your rent, your groceries, and your children's future. By the end of this, you'll understand exactly what Warsh wants to change, why markets reacted the way they did, and what this means for your money through 2026 and beyond. Bookmark this. We'll test these predictions in 90 days. This isn't about politics. This isn't about ideology. This is about incentives. Pure, cold, unavoidable incentives. I've spent decades watching central banks, watching what happens when new leadership takes over, watching how policy shifts ripple through currencies, commodities, and capital flows. And I'll tell you something simple. When a president names a Fed chair who's been publicly calling for deep rate cuts, balance sheet reduction, and regulatory overhaul all at once, you don't ask if change is coming. You ask how fast and how far. Here's the answer. 3 data points, 3 pressure points. Each one alone is significant. Together they create a Lollapalooza, a compounding of forces that will reshape American monetary policy. But the third data point is the one that turns speculation into certainty. But the real danger isn't Warsh, it's what comes after him. And this is where the pattern becomes impossible to ignore. Here's the first signal. The moment Trump announced Warsh, markets repriced. Dollar up, gold down sharply. Global stocks higher. Now zoom out. Markets are voting machines in the short term, and they just voted on what Warsh means. Here's the trick. Gold crashed because Warsh is perceived as someone who supports lower rates, but not reckless easing. The dollar rose because he's seen as more predictable than the alternatives. Stocks edged higher because lower rates mean cheaper borrowing and higher valuations. Here's the uncomfortable truth. The market isn't pricing in chaos, it's pricing in controlled change. That's a crucial distinction. Some of the other potential nominees, the ones Trump considered, were associated with much more aggressive easing. Warsh isn't that. He wants lower rates, yes, but he also wants a smaller Fed balance sheet. And those two goals create tension. Here's the short version. Warsh believes the Fed's massive balance sheet, built up through years of bond buying, is trapping liquidity in financial markets instead of flowing to the real economy. His solution? Shrink the balance sheet, redeploy that liquidity, and use lower policy rates to stimulate actual economic activity. That's not reckless. That's a coherent framework, and markets recognized it instantly. When incentives align like this, outcomes stop being opinions and become math. There's one risk Wall Street doesn't want retail investors to notice. If Warsh shrinks the balance sheet too fast, liquidity vanishes. And when liquidity vanishes, asset prices don't correct. they collapse. But the real shift hasn't started yet. Keep this in mind. It connects to everything that comes next. Now, the second data point, and this is where the situation turns serious. Kevin Warsh isn't a newcomer. He was a Fed governor from 2006 to 2011. He was Ben Bernanke's chief liaison to Wall Street during the 2007-2009 financial crisis. He's been inside the building, and he's been criticizing it ever since he left. Here's the uncomfortable truth nobody wants to say out loud. Warsh didn't just resign from the Fed. He resigned because he disagreed with the direction. He was concerned that Bernanke's massive bond purchases would stoke inflation. Those concerns proved misplaced at the time. Inflation stayed low for years. But here's what happened next. The balance sheet kept growing. The Fed became more entangled in financial markets. And when inflation finally did spike in 2021-2022, the Fed was slow to respond, in part because unwinding the balance sheet had become so complicated. Warsh has been making this argument for over a decade. He's called for slimming the Fed's balance sheet, easing bank regulations, refocusing the Fed on its core statutory mandate, and, crucially, steep rate cuts justified by productivity growth he believes the Fed is underestimating. Pause. Forget politics. Think like capital. Warsh thinks the Fed got too big, too slow, and too disconnected from the real economy. Now he's in position to fix it. That's not speculation. That's his stated agenda. Now here's the part Wall Street is quietly nervous about. Warsh also argues that artificial intelligence is supercharging productivity growth, and the Fed is underestimating it. If he's right, rates can fall faster without triggering inflation. If he's wrong, inflation comes roaring back, and your purchasing power gets destroyed again. This is the turning point, and this is where the system starts shifting. Now, the third data point, and this is where the situation turns dangerous. Warsh has been nominated, but he hasn't been confirmed, and confirmation requires the Senate. Here's the dangerous part. Senator Thom Tillis, a Republican on the Senate Banking Committee, just said he'll oppose any Fed nominee until the Justice Department's criminal investigation of Jerome Powell is fully and transparently resolved. His exact words, "My position has not changed. I will oppose the confirmation of any Federal Reserve nominee, including for the position of chairman, until the DOJ's inquiry into Chairman Powell is fully and transparently resolved." This is the turning point. Republicans hold a 13-11 majority on the Banking Committee. All Democrats are expected to oppose Warsh. If Tillis holds his position, the committee deadlocks, and the nomination stalls. Here's the uncomfortable truth nobody wants to say out loud. This isn't just about Tillis. This is about what the investigation represents. Powell called the criminal probe a pretext to pressure the Fed into setting monetary policy as the president wishes. And here's what Powell might do next. His term as chairman ends in May, but his term as a governor doesn't expire until 2028. He could stay on, not as chair, but as a voting member of the Fed, specifically to prevent what he called political capture of the institution. Think about what that means. Trump names Warsh as chairman. Powell stays as governor. Two men with fundamentally different views on Fed independence, sitting in the same room, voting on the same policies. This doesn't just affect Wall Street, it affects Main Street, your rent, your groceries, your children's college fund, your retirement. When the people who control money start fighting over who controls the controls, that's not noise. That's institutional fracture. Why these three forces together make the outcome inevitable. Now let's connect the dots, because this isn't random. This is a pattern. You have markets repricing instantly, signaling that Warsh means lower rates, but not chaos. You have a nominee with a decade-long agenda, balance sheet reduction, regulatory rollback, and a fundamental rethinking of how the Fed operates. You have a confirmation fight brewing, with at least one Republican senator blocking progress and Powell potentially staying on to guard the institution. Three different pressure points, three different sources, one direction, change. But here's the inversion. What would have to happen for this to fail? Tillis would have to back down, Democrats would have to support Warsh, Powell would have to leave quietly, the criminal investigation would have to be resolved transparently. Does that sound likely to you? I didn't think so. When incentives align like this, the outcome stops being a guess and becomes a mathematical inevitability. The Fed is going to change. The only question is how messy the transition becomes. By mid-2026, we'll know if this was a reset or a mistake. So where does this end? The Fed's 3 rate cuts in 2025 brought its benchmark rate to 3.50%, 3.75%. Earlier this week, citing stronger growth and a stabilizing labor market, the Fed held rates steady. Markets don't expect another cut until the June 16-17 meeting, when Warsh is expected to be in place. If he's confirmed, here's the sentence that tells you everything. Senator Bill Hagerty said Warsh would be good for Fed independence and would refocus our central bank on its core statutory mandate. But Powell called the investigation a pretext. Tillis is blocking nominees, and Trump has already tried to fire Fed Governor Lisa Cook in a case now before the Supreme Court. If successful, that would be the first time a president has ever fired a U.S. central bank policymaker. This isn't noise. This isn't politics. This is a structural shift. Money is losing honesty, and markets can feel it. The Fed has long been seen as a stabilizing force in global markets. That perception is being tested, and by the time most people realize what's happening, the regime change will already be underway. So what do you do with this information? 3 things. Cold, logical, no emotion. First, understand what Warsh wants. Lower rates, smaller balance sheet, less regulation. If he gets confirmed, expect policy to shift in that direction. That's not speculation. That's his stated agenda. Second, watch the confirmation process. If Tillis holds, the nomination stalls. If Powell stays as governor, expect friction. Either way, uncertainty continues. Third, recognize what markets are telling you. Gold crashed, dollar rose, stocks edged higher. Markets are pricing in controlled change, not chaos. But controlled change is still change, and change creates winners and losers. None of this is advice. All of this is arithmetic. I've spent my whole career trying to understand incentives, and right now, the incentives are screaming. Trump wants lower rates. Warsh wants regime change. Powell might not leave quietly. When the people who control money fight over who controls the controls, everything downstream must adjust. This isn't about morality. It's about simple arithmetic. Subscribe if you want to think like capital, not like victims. I'll keep following the numbers so you don't have to guess.